This is our Forex blog for May 14th, 2012. And like most days, we really want to buy the strongest currencies versus the weak, and we want to sell the weakest currencies versus the strongest. So starting out today, you can see our real-time dollar and yen on the top. These are the two pairs that most people trade. And the daily, weekly, monthly trend is on the bottom in color strip. And above that is the 15 and hourly trend. So real-time trend, 15 hourly, daily, weekly, monthly. The more that these line up, the more likely the trend is to continue. And when you see patterns of extreme strength at and above the 80 level, followed by a very tiny amount of pullback, half or less, extreme, half, extreme, 1/3 less weakness. This is the kind of pattern that is very likely to resume the trend, especially when the longer time frame trends, hourly, daily, weekly, monthly, are all up. Notice the same thing with the yen. Extreme strength, almost no weakness. Extreme strength, almost no weakness. These trends are very likely to continue until you see, a decent powered amount of weakness like that. And then when that happens, if all the other time frames are up, typically an hour, hour and a half later, the previous trend will resume. So you can see the weakest ones: Australian, New Zealand, Swiss, the euro later in the day. So let's look at that. You want to sell the weak euro versus the dollar and the yen. So here's a 5-minute chart using our trailing stops. You can see, that trend did go down, and it pretty much ended right at my Fibonacci profit target levels. I personally prefer range charts. So here is a 6 pips per bar range chart that you can see has very good entries just using our trailing stops. End at 84, out at 73, small profit. Short again here at 71. It got you all the way out down here at 39. And this move down right there is over a 30 pip move. Getting 10 pips per day doubles your account every 2 months. So, and that's using about 2% risk of your account size, per trade. So if you have a $1,000 account, you're risking $20. If you have a 10 pip stop, that means you can trade 2 mini lots. So a 30 pip move with 2 mini lots is $60, which in this case would be about a 6% return on your account with just this one trade. Now, this is a 6 pips per bar. One of the things I'm working on, traders have always told me, there's 2 ways of approaching becoming a profitable trader. Spending hundreds of hours learning all that you need to learn. And most traders don't even realize how little they know. There's 50 to 150 things that they don't know. Daily, weekly, monthly pivots, support, resistance, Fibonacci areas, many different entry signals on range charts, how our statistical tools can be used more successfully. So what I'm doing now is working on trigger bars that show up on your charts and tell you that, to be watching for either a buy or a sell. So let me bring that up right now and we'll go over those. Here's a 5 pips per bar range chart with these entry signals. Now, they only show up mainly in the direction of the trend. If the market goes up or down too much, especially outside these green bands, we do have counter trend signals that are very, what I consider to be very accurate. And if the first trade loses, usually the second one wins. And when they get stretched outside these 3.0 green bands, you typically can get 25 to 50 pip moves. But when you get these signals, and I don't even know what I'm going to call this in the software yet, it should be released in about 2 weeks. When you get one of these signals, basically you want to sell it when it goes a pip or two below those bars low. So you can see in this case right here, it went from 83 down to 73, 10 pip move. This trade right here, you would enter right here at 75 and only went down to 68 and then came back up. But basically, if you get into these trades and move your stop down, most of the time, the ones that don't work, you should have a 2 or 3 pip loss or a break even. In this case right here, 78 and went down and kind of went sideways. You might get out at 70. I have a lot more signals I'm looking for to put in, but I haven't done yet. One of them is a up, down, up, down, up, down pattern. When it breaks the low, you get short. So not all of them are in here. You got an entry signal right here, which fell from 45 down to 25. That's 20 pip move. Short again right here at 45. Went down to 34. So the point is, most of these entry patterns are really going to help new traders. And one thing I've noticed is that when they don't really result in very big profits or small losses, typically if the market breaks above, let's say in this case 28.50, you're going to get a big counter trend move. That's what I've noticed. So let me start, or let me go over the euro yen now. Again, the euro extremely weak. The yen also very strong, especially later in the day. It had a little bit of weakness coming into today, but for the most part, after around 5:30, it was extremely strong. So you want to sell the weak euro versus a super strong yen. Okay, so this is what this looks like with the sell signals as well. You can see here's a trade that you wait till it goes below that bar's low, you get in, you probably would have lost 10 pips here. And these trades don't pick up every single pattern. Like, again, I said, the up, down pattern typically is pretty successful. I haven't coded all of my patterns that I personally try to look for in my own trading, but you would have been a short again here, and you can see that one worked. This one here lost. This one here lost. You had a short here that ultimately fell down to 08 from 16. This trade here would not have been triggered because it never broke that bar's low. So again, these are just trigger entries. You're short again right here at 23, pulled all the way down to the whole number. Entry right here, you can see it kind of went sideways. You wouldn't have much of a loss. Nice pullback right here. And a lot of traders, there's a lot that new traders don't know. One thing that most traders don't know is the small percentage of your winning trades are going to be very nice, giant, 20, 30, 50 pip wins. The majority of your winning trades are going to be small 5 to 20 pip wins. But eventually you're going to get into a nice trend here, and you can see this one fell from 103 pretty much all the way down here to 33. Now whether you want to take the counter trend signals or not, it's up to you, but they're very highly probable areas that the market's going to stall. So you start getting some big counter trend signals, you can really start looking for, pushback trades. And typically, I like to, depending on how strong or weak the currency is, I like to, when it gets down too much, wait for at least a 2-wave pullback before I personally want to aggressively sell it again. So, these signals are meant to be discretionarily traded. This is kind of the area that I would like to sell. This is called our Elliott 2-wave fib pullback system. And just because there's sell signals down here doesn't mean you have to take them. You can use these in addition to Fibonacci and all the other stuff that we teach, which is more reason to learn some of our more advanced patterns. So anyway, as you see this coming up and hitting this fib target, because there were quite a few sells, this is an area I would be selling right here around 56. It's down about 8 pips so far, and we'd still be in it because it's extremely weak, and we want to see if it can come down and test the lows down here. It may have another 25 pips or so to go. But these signals are really helpful for new traders. And especially when you get into trades in the middle of the range, the lower containment bands oftentimes are when price stalls and reverses, like you saw here. So when you see signals in the middle of the range, you have more potential of bigger, pip moves. Like you saw this signal right here led to, even if you got out of it right here, you made 25 pips in a very short amount of time, 20, 30 minutes. That's phenomenal. And again, that's maybe 10% of your trades will do that. The other 90% won't. There will be small losses, break-evens, small wins, medium wins, and so forth. You also see extreme weakness in the Australian and the New Zealand. And the New Zealand's much weaker than the Australian. So let's look for sells in the New Zealand dollar and also New Zealand yen. So here's the New Zealand dollar with my trigger alerts and sell signals on it. You're looking for sells pretty much most of the day. You have a nice 3-bar pullback right here where you'd be short at 89. And you can use our trailing stops, or again, you can draw fibs on the charts and just simply get out at or near the fib targets. That's what I typically do. So I would be short right here at 89, and it comes down to the fib target down here. It's way underneath the white band, and very rarely does it go beyond the 3.0 band. So this 3.0 band is at 65. It touched 70. You only have 5 more pips to go. Why would you risk giving back 5 or 10 pips to only make another 5 pips? That doesn't make any sense. Trading is mostly common sense. So you get short. You get out of your trade right here at 70. you were short at 88, so you made 18 pips on that. And a lot of times currencies that are this weak, they'll pull back and they'll either continue. So you might be short right here. It looks like you got stopped out there. You got short again right here at 75. Again, it came down to the lower containment band, which is also the low of the day. Double bottoms are oftentimes the end of the move. So you get out of your trade right here. You probably made 15, 16 pips. You lost 8 pips on the other one, and you made a very nice profit on the first one. Now, this signal right here, the market's kind of going sideways right here. It really never went below those bars low to trigger an entry. However, like I said before, Elliott two-wave patterns are wonderful, and when you see these big sell signals right here, draw your fibs on it. It's extremely likely to reverse at these fib targets. So again, I would be short this at 93. It's already pulled back 17 pips, and pretty strongly. This is one of the weakest daily, weekly, monthly trends that we have. One of the highest probability. And if you wait for and you use these trigger entries with a little bit extra common sense, that it's very hard to teach a computer how to draw fibs and to wait for two-wave Elliott pullbacks. But if you watch our classes and you use our currency meter to identify the ones to be looking for, and then take trades, and possibly rule out some that we don't have the real-time momentum tools on here. If you're in this trade and it went up and it kind of is grinding down right here and it's not that weak at this time, you can get out of these trades with 4 or 5 pip losses. And that's the key. If you have, even if you're 50% right or even 40% right, and you're getting 20, 30 pip wins and your losses are break evens, 3, 4, or 5 pips, and you're catching an occasional 15 and 20 pip win too, guess what? At the end of the day, by focusing on the best ones, knowing a little bit more than that we teach in our classes, Elliott two-wave fib system here, along with these entries, can dramatically help you avoid possible trades like this. If you shorted this one here and it immediately reverses, that's usually a sign the trade's not going to work. I oftentimes get out of those trades immediately. Most winning trades for me go my way immediately with almost no pullback, so I'm pretty quick to get out of the trade if it reverses. I'm going to end today's Forex blog by reviewing the New Zealand yen. We saw with the currency meter that this one also was pretty much a no-brainer to be looking to sell, right? So we know the direction, and so we are focusing on taking sell signals. You have one right here that led to a small profit here, led to a small profit. This one right here was pretty decent. Fell from 41 down to the lower containment band. Nice 20 pip move. Short again right here at 22. And when they get down near the bands, typically they will reverse at fib targets. So whenever it hits the red or white band and you draw your fibs, the vast majority of the time it's not going to go below the fib target. So if you were short right here at 22 and it comes down to the 1.382 fib target, if it's stalled there, then get out. In this case, it went a little bit lower, but somewhere it reverses usually between these two. So this is one of the reasons why I would not be taking this entry. Because the fib targets are right here, I would expect it to either need to go sideways for a little bit before it breaks down or wait for a deeper pullback up. So I typically will wait for a little bit, 30 minutes, 40 minutes or so. You can see it came up, sell signal, came up again. It wasn't able to break that high. That is enough for me to enter it right here. There's no entry signal on the chart, but this is what I personally look for. And then you want to redraw the fibs. Just yank this down here, yank the high down to the last swing high. And again, don't be greedy. Get out of this trade right here at 86, short right here. And anytime a currency does go down and hits the lower white band at least 2 times like this, and it can't penetrate it, usually you're going to get a 2-wave pullback. So again, these are entry signals. It never even broke the low, so that one doesn't count. Remember, these are going to show up on the chart as a guidepost. You might decide to get into a trade here and lose, but again, just like I said before, I prefer when a market's down a lot, when it comes to my own trading, my own money, to wait for an Elliott two-wave pullback. So here it is, and we happen to get a signal right at an area. This is one of those things I might do a little bit larger lot sizes on because it's probably 80–90% likely to work. Short at 21, it's already fallen 13 pips. It's one of the weakest ones. So by using these entry patterns in conjunction with, I don't even have the real-time statistical strength tool, which is not even built into this. and when I am able to add that, it should improve the signals. Some of them won't show up, other ones will, and so forth. But nonetheless, by using this in conjunction with what you know from our classes, like Elliott two-wave fib pullbacks, extremely weak currencies that have gone down too much are more likely to have at least a two-wave counter-trend move before they continue. You can get into trades like this and make 10, 15 pips versus, having a 10 pip loss, 5 pip loss, being down 15 pips. You wait and you have a profitable trade instead. Or you get into a trade, right here. The beginning of the trends are always the best. Here you short, it broke, it made a new low. That's good. That makes this trade worth taking. Now it's near the lower containment band. Do you really want to risk 10 pips to maybe only make 10 pips? No. And so I probably wouldn't have taken this trade either, even though it did go down.